Briefly, I'm going to walk you through 2008's investment climate and the returns. I really shouldn't have gone any further than simply letting this guy sum it up for us.
This past week, global stock, commodity, and currency markets suffered a severe crash. Especially hard hit, everything. Bad news for those invested in something. The something bubble has burst, and rightly so. It was a silly thing we all got caught up in. The one safe haven, nothing. If you invested in nothing because you thought nothing would do well in the future, good call. Your optimism has been rewarded.
Should have left it at that. So let's go back. You know, we are very transparent. Now transparent is cool, right? We were transparent when it wasn't cool. So let's go back and look at our projections for the year and see how we did. First of all, on the equity side, we stood here and told you it was going to be full of sound and fury, but that upside opportunity and downside risks would be equally balanced. We were a little bit more bearish than that internally, but obviously it ended up being a 100-year event. We didn't see that coming, so we were wrong. In terms of size, we thought small caps would outperform large caps. We tried to organize the portfolio that way. That was true. We thought that the value style would outperform the growth style. That was true. We thought that domestic equities would outperform after years of underperformance the international equities. That was true. In terms of U.S. interest rates, we thought that the Fed would have to lower interest rates and therefore the yield curve would steepen, which it did. In terms of the U.S. dollar, we were in the minority, clearly in this opinion, but we thought it would enjoy a technical rebound as some of that money had to get repatriated, and it did have a technical rebound. And then finally, on the bond side, we thought that all of this turmoil in the market would create great dislocations, which would present for us terrific opportunities. While that is the case, and I believe that to be true, certainly was not realized last year. So here's our report card. You know, it was clearly an eventful year. It began with a rogue trader at Societe Generale who stole a few $1 billion. And then in March, we had Bear Stearns go under. The Fed came on with the fire truck, lowered interest rates dramatically, extended lines of credit to investment banks, which it had never done in the past. And there was a shotgun marriage arranged between Bear Stearns and J.P. Morgan. As we moved on during the summer, we saw IndyMac fail. Remember the lines outside of that bank in California. Freddie and Fannie ended up going into conservatorship. And then Merrill Lynch and Lehman Brothers, AIG, WAMU, they all failed in rapid succession, which mobilized the cavalry. And so the $700 billion TARP legislation was brought to the Hill and ultimately approved. Also during that period, the SEC tried to prop the market up by banning short selling of financials. And we went on into the end of November, or the middle of November, and finally they put an IV into Citigroup, and that was actually a little shareholder friendly, so we got a little bit of bounce off of that, and then we had an auto bailout in there too, but I couldn't decide which emblem to put up there. All of this was extremely painful in the markets. Everybody knows that. So the only places to hide last year, really across any asset class, were gold was actually up 5%. You saw what happened to gold stocks, so they completely decoupled. If you owned the bullion, you were okay. The U.S. dollar was up 6%, and the mattress that the world stuffed its cash into was the U.S. Treasury market, which was up 14%. Everything else hemorrhaged. So here's emerging market bonds, here's hedge funds, here's the S&P, here's some more stock markets, and then you get down to the commodity side of things. By the way, traditionally, in down markets, oil is a good place to hide. Last year, not so much, down 60%. So again, very hard, even if you called it, to figure out where to hide. Was there any advantage between size of company or investment style? The answer is no. There was a slight advantage in small cap value and small cap blend over large cap blend, which is the S&P. But when you look at it from the top, the advantage was not really all that meaningful. What about industry advantage? Well, no real place to hide here either. Here's the financial services industry, which, by the way, as of this afternoon, has now fallen 81% from the top. But at this portion, it had fallen 54%. Materials and technology suffered as well. The traditional defensive sectors of the market where you can hide, healthcare, consumer staples, and utilities, they were down between 20 or 30%. So that wasn't a comfortable place to be either. Geographic advantage, you wonder why we've got this PR problem. We were the ones that caused all the problem, and yet we had a much better rate of return in our stock market last year than all of our trading partners. Japan beat us, but they go down every year, so that's not really fair. Here are the emerging markets that we talk a lot about: Russia, India, Brazil, and China. We infected them, and you can see the kind of returns that came out of that. So was there any place to hide? No, not really. You were better off in the US.